Welcome, everyone, to the Passive Investing Made Simple Masterclass. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at PassiveInvesting.com. And today we're going to tackle the question, should you invest in passive real estate now or should you wait? Should you actually hold off placing an investment in a passive deal, whether it is within debt or equity? Now, if you haven't joined us before, we do this masterclass live every Tuesday to help you learn the ins and outs of passive real estate. Now, I want to kick it off here though. We asked the question, should you invest in passive real estate right now? And I actually challenge you that that's the wrong question to be asking. Okay, so I participate in a lot of the investor forums and I see that question all the time. Should I invest now or should I hold my cards close to the chest, keep my cash safe in the bank? But the question is not so much, should I wait to invest, but how do I invest in passive real estate? And here's the thing, there is no such thing as perfect timing. Okay. What we need to have is the right portfolio structure to allow us to preserve our capital, create cash flow, and get some real upside right now, taking advantage of what's happening in today's environment. Now, today's webinar, we are really going to be, focusing on people that are high income earners, people that are focused on capital preservation. Maybe you're even a little bit equity hesitant. Okay. I get you. I have you. I understand that your pain point is if I invest in passive real estate right now, I don't want to lose my principal. Or what happens if I make a mistake? Right there with you. Okay. So, again, we do this masterclass live every Tuesday to help you take your active income and turn it into passive income and long-term wealth. So that it doesn't matter whether you've tried investing in a deal before and just couldn't get comfortable making the investment, or actually invested in a deal before and went, maybe I didn't have the right plan in place, or you are a seasoned investor and you just want to sharpen your skills. Now, if this is the first time you and I are meeting, again, welcome. I've been investing in real estate since 2002. I've scaled a sizable portfolio on the active side of investing. But here's the thing, I was not able to unlock those golden handcuffs, okay? It wasn't until I actually started investing in passive real estate that I was able to create cash flow, consistent, predictable cash flow for myself and my family. And that is what's allowed us to do what we want to do, travel the world, spend time together as a family, continue to do those things that allow us to create an impact in the world. And I've documented my journey in my book, Money for Tomorrow, but I also lead you through a lot of those lessons and learnings here in the Passive Investing Made Simple show. So be sure to check out my book. You can, check it out on Bigger Pockets or on Amazon.com, or stay tuned to this webinar series. Now, everything that I teach is in service of one thing, showing you how I got my result, which was 100% control and choice on how I spend my time. Okay, that is really what we're all after. Okay, you might be saying, hey, I want financial freedom or I want financial independence. Okay, but here's the thing, we all just want to have our time back, control and choice on how we spend it. And we can help you do that here at PassiveInvesting.com, whether it's through our equity assets or through our debt investing assets, such as our real estate debt fund. Now, regardless, I want you to go ahead and invest in yourself right now. Join the Passive Investing Club. When you register there, when you go to passiveinvestingwithwhitney.com, there you'll get a free one-on-one call with me. We can help you identify those goals, connect you to additional resources that will help you meet those goals. And if you're ready to invest, we can even connect you to the investment. Now, let's go back to our question today. Should you be investing in passive real estate right now in today's market? Okay. Now we're going to touch on some things at a very high level, financial, legal things. Okay. But this webinar series is educational purposes only. So make sure to take the content back to your investment team before making any decisions. Now, I think it would be only fair here is for me to kick this off telling you my story. Okay, so I started off investing in real estate, buying my first properties back in 2002. Started living, flipping, and house hacking. Really was very largely unaware what was going on in that greater macro environment come 2005 and 6. Okay, I just knew I could turn the roof over my head into an equity asset. And honestly, like if I rented it out, I could actually cash flow it too. Okay, repeated that play over and over and over and over again. Okay, built up a large sum of equity through our residential real estate. Had over 40 single family rentals at one point in time, several doors, actively owned in multifamily real estate. But eventually thought it was the height of the market, cashed out. But here's the thing is I wasn't able to get it all deployed. And then right around 2020, COVID happened. And then we saw the dip in COVID in real estate. Then it started to rebound. And then I still didn't feel comfortable to getting everything deployed, putting all my eggs in one basket. So I just stacked cash, right? I over, I had too much in reserve sitting on the sideline, okay? Because I just thought that, hey, have a huge equity position already allocated into real estate. I'm looking at other businesses to invest in, but I just felt everything was a little bit risky. Okay. So I continued to stack cash. Liquidity was a little tight too at some point in times. But the thing was that I realized that while protecting my capital, I actually was stalling my growth. Why is that? Is because I had all that cash stacked up in the bank, losing to the inflation train that was just barreling down on me. Okay. So that's when I really started taking a look. Okay, if I've got my liquidity reserves met, what can I do with my cash past that to keep it earning and beating inflation, and at the same time, keep it accessible if I needed to, place inject funds into a particular asset. We still have some single family rental properties. I mean, I think during this time we had a boiler go out on one of them, which is not cheap. Okay. But the thing is here, this whole stalling story, okay, I pivoted from losing tens of thousands of dollars a year to actually making tens of thousands of dollars a year just by a simple shift, but not putting my capital at risk, keeping very predictable cash flow, keeping that liquidity going, and if I can, taking advantage of compounding and staying flexible for when equity deals do start to rebound. So I want to lead you through a framework. Okay, that's just my story. And I always like talking in frameworks. How can I give you a tool to be able to look at your own situation, saying in where you can actually look at the cash and reserves that you have on hand? What should I be doing right now in order to position myself in today's market? Okay, so remember, the question isn't should I invest in real estate right now in today's market, or passive real estate in today's market? The question is how. Okay, so this is the how. So number one, make sure that you're preserving capital, right? Make sure that you are protecting your principal in low volatility investment structures. Okay, that could be debt. It could also be equity, okay? But we just want to make sure that it is very low volatility structure, okay? Strong underwriting, incredibly strong reserves with very clear exit strategy on that. Now, why do we want to focus so much on the preservation piece? Well, if I don't get knocked out of the game, I can live to play the game again. Also, this is the number one rule that our buddy Warren Buffett, one of the best investors on the planet, subscribes to. Rule number one, don't lose money. Rule number two, see rule number one. Okay, so we want to make sure that we are doing what we can to preserve. Now, it doesn't mean things don't go wrong in an investment. I'm not saying that. I'm saying we want to do what we can to preserve, okay, which means we probably are looking at our risk tolerance profile and our risk capacity profile. We covered that in our last webinar. All right, number two of this compounding trifecta is making sure that the investment pays. All right, now I personally love cash flow. Okay, a lot of people will, investors will push back on me whenever I have a conversation with them. They'll be like, I don't need the cash flow right now. I have a job. Great. Market shift. Layoffs happen. But if something is producing predictable cash flow month over month, quarter over quarter, you can compound that cash flow and continue to grow, right? So this allows us to do several things. One, if you need the income stream, you can take it. If you don't need the income stream, you can reinvest and compound and grow, okay? Two, if you don't have your reserves built up, you can actually stack up more dry powder for reserves or dry powder to go into a higher risk equity investment, right? But cash flow is king. It's what allows you to do this. Okay, then the third phase of this compounding trifecta is making sure that you're reinvesting your income strategically. Another mistake that I see a lot of investors make is they take their cash flow and they use it to pay bills, right? They are paying their bills without being strategically free yet. Okay, there's nothing wrong with that, but if you want to grow your portfolio, the quickest way to grow your portfolio, or any business for that matter, is to reinvest your profits. Okay, because when you can reinvest strategically, compounding time works for you. All right. And then when you're ready to pivot, okay, to just equity only, really building out the equity side of your portfolio, you're able to do that. Okay. You've got a nice cash generating engine underneath you. Or maybe you're ready to retire and you want to start paying the bills with the cash flow. Okay, you're able to do that. But regardless, we have to invest for preservation. We have to make sure those investments are paying us, and that they're positioned appropriately for where we are in our investment timeline. And then we just need to continue to repeat the process. All right, so I wanted to give you some numbers, right? Because this is another myth that I often talk to investors about, is they were like, Whitney, I hear you loud and clear. I could invest in a cash flowing, say, debt fund and get monthly income, but that is one, boring. Two, I'm not going to grow like I would if I just hung on for another year to find an equity investment. And I'm going to dispel that myth right now. So this is an 8-year mathematical comparison of 3 different investors. Investor 1 decides to wait all in cash. They're nervous Nelly. They're going to sit out the market. Okay, they're maybe, have their funds in a interest-bearing account, say $200,000, right? And they're earning maybe 2.5% total. Okay, but they're losing, 3.5% to inflation. Okay, that's what the inflation number was last week. So they're actually, sorry, this is $250,000 invested annually. So their first year, 2 years of sitting all in cash, their 250 has gone down to 239. Over the course of 8 years, they've actually eroded down to 218. Now, we all cross our fingers that sitting, in a down market for 8 years doesn't happen. Okay. I picked 8 years for a specific reason because our longest down market has been closer to 4. Okay. So that's double, but nonetheless, they're nervous Nelly. They sit all in cash. They think they're protecting themselves, but if inflation stays high, they're continuing to erode their wealth. Now, you and I know that we're ready to invest, okay? But we just don't know whether we want to go in debt or equity, okay? Let's pivot to investor C, somebody who's like, you know what, Minnie, I love what you have to say. I totally see it, but I am not in retirement. So I am going to take a little bit more risk and I'm going to wait for the equity deal to come online. Well, let's see, investor C, they wait 1 year, okay? And let's assume they're just looking for an equity deal, not a huge home run, but something that over the course of 8 years is going to give them a 1.7x equity exit, okay? 7, 8 years. Okay. Now their initial $250,000, there's no growth in year one. And probably in all reality, if that money is sitting in the bank, they're losing. But this person's smart. They've kept it in money market funds and they're just barely keeping up with inflation. By the time they get invested, okay, but in year two, and by the time they exit, after the 7 year hold, they probably have made $425,000. Okay, their initial capital back and their growth. All right. But investor B, they actually got invested in a 8% debt fund, reinvested those proceeds quarterly, didn't touch it. And by year two, they have $291,000. And in year eight, they've got $464,000. Here's the thing. Investor B avoids sitting idle. They earn consistent income and they allow it to compound. Investor C might get a higher upside if the deal performs, okay, but loses a critical year of growth waiting. And of course, we already know what happens to investor A. They get eroded by inflation by quote unquote playing it safe. So here's our market timing checklist. Like if our question is, should I invest in passive real estate in today's market? The answer is yes. But then the question is how? Okay, this the follow-up question here. So I wanted to give you a little bit of a timing signal checklist. Okay. So right now, if you're still kind of like that nervous Nelly, investor A, not ready to go in an equity deal, debt funds, properly underwritten, first position lien debt funds with zero deficiencies, zero leverage is the place to be. If you're looking for one, email me and I'll help you out. But if you're the investor C who's like, I'm trying to figure out what my next equity play is, and I don't want to wait a year and risk losing out on that growth, well, here you go. We want to make sure we're looking for investments that have improved loan to value. Okay, that lenders are showing confidence. Okay, this is a kind of our checklist. If we can check multiple of these boxes, it might be a good time to go into an equity deal. Bridge debt availability is increasing substantially. Now, somebody might be sitting here, you might be sitting here going, Whitney, I don't want to go in a deal that has bridge debt. I'm not saying do that. I'm just saying if we see bridge debt availability increasing, that signals that the market is getting stronger. DSCR metrics consistently greater than 1.5x on pro forma. Okay, if we're seeing deals where the DSCR metrics are greater than 1.5x on the actual pro forma projection, okay, that's very, very strong equity deal. That might be a check in that box. Okay, now 1.2 is respectable, but we want to see a little bit higher. An equity deal that has a clear sponsor exit strategy and cash flow visibility today, right? We want to see in that equity deal operational, reserves already built into place, 6 to 12 months minimum, right? And then from the market, we want to see compression, cap rate compression. Okay, that's signalizing that signal right there is telling us as the investor that the pricing in that market is stabilizing. All right, so again, your question to answer, should I invest in passive real estate in this market? That's not the right question. The question is how. So we showed you that trifecta framework that you can follow. We showed you what market signals to pay attention to. We showed you 3 different investor types. I want you to consider which investor type are you really, and which one do you need to be, right? But remember, you're not just an investor, you're a capital allocator. You have your hard-earned money sitting in the bank. We need to allocate it appropriately. So understand the risk. Why waiting may be riskier than you think. Apply that framework that I showed you, compare your options, and then watch for those market signals. Right? This is your invitation to join me in the Passive Investing Club and up-level your skills there. You and I can jump on a one-on-one call conversation to discuss your investing goals. I can connect you to additional resources and then possibly to additional deals. Now, if you're here live, don't go anywhere. We're about to start the Ask Me Anything part of our show. All right, guys. What did you love? What would you love to see? Was this useful? Go over to your chat box, drop in those questions in either the chat or the Q&A, and we'll take a moment to get those answered. Awesome. Somebody said 100% useful. Amazing. I wanted to leave you guys with a little bit of framework of how to think about investing in a passive deal in today's market, but two, to show you the math between the three different scenarios that I see most commonly happen amongst investors. One, waiting all in cash. Okay, going, so I'm just going to stay on the sideline. Two, going into a debt fund today. Okay, and then three, going into waiting for the equity deal. Okay, now here's the thing, you can kind of combo this. Again, we have opportunities here at passiveinvesting.com where you could go into a debt fund that has liquidity. Okay, you don't get eroded by inflation, and you can set yourself up nicely for a liquidity event when you do find that equity deal. Now, I saw a hand being raised. If you would, for me, go to the Q&A box or the chat box, drop in your question. I'd love to answer it for everybody. And if there are no questions, I'll hang out here for another minute. But more importantly, thank you for spending your time with me here today, but more importantly, investing in yourself. Next week, we will be joined by a guest speaker. We're going to talk about all things self-directed IRAs. And this isn't going to be the same boring conversation of like, what is a self-directed IRA? We are going to get strategic on how you, as an accredited investor, need to have one of these in your portfolio. I'm seeing multifamily doing worse lately, as if it's just experiencing the oversupply impact. Is that what you see? I would say all market dependent, right? And that's the thing. If you're reading all these newsletters and headlines and CNN and Lord knows who else, they're talking about multifamily globally. We want to make sure that we're actually observing what's happening in multifamily in the specific markets where you want to invest. Okay, so this is where I say don't look at the headlines. Okay, look at the actual expert market reports in your area, and then trust but verify what you're seeing from that operator in that particular market. Okay, because operators, they believe in the market. That's why they're there. They know the market. They're intimate with the market, but you want to trust but verify that data. Okay, now here's the thing. If you're investing in Austin, Texas right now, I would 100% agree. It's very, very challenged market. Okay, it's got a lot of oversupply to absorb. If you're investing in parts of like South Carolina, that absorption has largely already happened. Okay, it's already happened in the West Coast too, in a lot of West Coast markets. Okay, and a couple in the Northeast. All right, so we're starting to see those markets hit the bottom and then start to come out on the recovery side of things. But if you're in Austin, well, I mean, guys, I don't know which way we're going here, but you're hitting hyper supply and you got a long ways to go. Absorption in say, and I'm just picking on Austin, love Austin, but we've got another probably 2 years, 2+ years to see all those deliveries be delivered, absorbed into the market, whatever happens with concession and rent decline, and then we're going to start seeing the raise out of those markets. So it really is hyper local. I would say that national indicators from multifamily are starting to largely turn green, and I think they'll turn greener over the next few months. But the reason why they're turning green is because the market, the lending market is already for multifamily is already priced in that rate drop that we saw from the Fed last week. I saw lots of headlines talking about assisted living facilities or they are coming out of the COVID downturn. Yeah, again, here's the key word here. We're saying headlines. Okay. Again, all market dependent. Like I'm in an assisted living facility investment in the south part of the United States. It's seen weather-related events, multiple weather-related events, lending issues, COVID. So I think we're going to, see a kind of a little mini bounce back on assisted living. Now, here's the thing. We've got more and more people. I mean, baby boomers, we're just starting to see a lot of them move into these type of facilities. And I think that's going to continue to grow over the next 5 to 10 years. Um, Now, one before you go, Whitney said to invest. That's not what I'm saying is to invest because you got to look at the other macroeconomics that are happening here. And that is, you know, with the current administration, if they get their way, there's going to be less funding and less insurance coverage for um, retirement, for Social Security, for Medicare, Medicaid. And so I think you're going to see a lot more people not able to go into these living facilities and have to figure out a way to stay at home longer. So again, the headlines are meant to grab your attention. Okay, but we gotta always go back and look at the underlying data and the macroeconomics that are at play. Okay, and really fully stand all the puzzle pieces. So it's kind of like my background is in health, okay, public health. And every time I see some sort of like article on public health, like they're covering a study, I always go, okay, there's the study. Let me actually go read the study. And like half the time, the person interpreting the study or the original data spun it to get a click. Okay, so we got to always go back and look at that original data. All right. What other questions do you guys have? Um, do I see foreclosures more now? That foreclosures in what area? I guess that, again, going to be very a local, locally dependent, and it's also going to be very tied to a particular asset class. If we're talking about single family foreclosures, I would stay tuned for, Q3, Q4 of not even Q3, Q4 this year, but like probably into like later parts of next year. I think it's going to be a really interesting time right around this time next year before the midterms. We've got hundreds of thousands like federal employees that are being downsized or let go. I'm curious, like, in slow job growth, slow economic growth, uh, and not that jobs are holding steady, but we don't have the growth. So if these people leave the workforce, is the current job market going to be able to absorb them? If you think about it, in 7 days, that was, the current administration has a lot of people, voluntarily leaving the federal workforce. So I'm curious how all these economic things that we have in play, when they start colliding over the next like 2, 3, maybe even 4 quarters, if we don't see other economic relief happening, there's a lot of downward pressure on the market right now. What will actually happen? So yeah, somebody said, thanks for reading my mind. Can't type fast enough. Yeah, totally. So if we're keeping it to single family, I think, again, I think that, but if we think about that, right? Where are the largest workforces, federal workforces? It's like Washington, D.C. I know I'm in Colorado. We have a very large federal workforce. Like markets like that are going to be really heavily impacted. Other markets, maybe not so much. Okay, so again, we got to keep perspective that things are going to be very regional, but what we don't want to see is the contagion effect. And I from everything that I'm reading, and again, I'm a side chair, you know, economist. I don't pretend to like actually have 100% grasp on everything that happens in the economy, but I think there's a lot of downward pressure, but nobody's really speaking about a contagion effect like what we saw in 2008. Um, so more to come. I think, over the next few months, we'll see a lot of things happening. Another question came in. Are you personally investing at this moment or holding all cash? That is an amazing question because remember, the whole point of today's webinar is should I invest in passive real estate? And I said the better question to be asking is how can I invest in passive real estate? Okay. And so the answer to your question directly, yes, I'm still investing. And this is the framework I'm following to invest in today's market. Yes, I'm continuing to invest. Why? Because I don't want to be investor A. Let's go back here. I have done the math. I know what happens to investor A. Even if they sit in a high yield savings account, they're losing to the market. Okay, they're losing to inflation and all these other downward pressures that are happening. Okay, I want to, I don't, maybe I'm not ready to swing for the fences on an equity growth play, right? For me, my threshold right now, it would be, for me to take the risk to go into an equity growth play, it's got to hit 1.75x or more. Okay. Otherwise, you can see the math plays out right here. The math, I mean, if I just stay compounded, in a debt fund right now in today's market, I can be patient. Okay. And that's really what we're trying to do here. Can we be patient? Remain liquid, okay? Not fall trap to the you have to get invested and grow and buy something at the bottom of the market because really, honestly, nobody really 100% knows where the bottom of the market is. And there's a lot of things that are moving in today's economy that, as soon as we start thinking we hit the bottom and maybe we get a little bit of growth, but then we hit it again. I think we're kind of on a little bit of a volatile roller coaster right now, especially between now and the end of the year. I saw another question come in. Let me clear the board real fast. If not for COVID, South Carolina would have grown by 43%. People over 65 are moving here from the Northeast and Midwest. There's definitely a need for assisted living here. I think that is a great indication that real estate is very hyper local. Okay, so if people are moving from the Northeast and the Midwest to South Carolina, one market is experiencing a boom, two other markets are experiencing a contraction. Okay, so that's one thing that when we look at our for our equity deals, we're looking at the supply demand metrics. We're looking at where the market movers are happening. Now, do we get it? Again, you can look at the data and make predictions, and we want to be right, 9 times out of 10. If we can be right 10 times out of 10, absolutely. Of course, we want to be right 10 times out of 10. But, we want to be way more right than we are wrong for sure. There's a couple of questions coming in about specific assets. I encourage you, if you have a question about a specific asset of yours, reach out to me at whitney@passiveinvesting.com. I would love to get you in touch with our investor relations team. They're going to have the most up-to-date current information on any asset. Somebody said I can't see the slides. I show that it's showing publicly, so not sure what's going on there, but I'll let you know this session was recorded. It will be on YouTube. Since you're here, you registered, you'll get the link, the recording link after for sure. All right. Any other quick questions before we wrap up today? Oh, thank you. Somebody said great session. Thank you. And I always want your feedback on what you want to hear about and how I can serve you better for sure. Yes. Again, people are emailing me about specific assets. Email me at whitney@passiveinvesting.com. Let's get you connected with the right person that answer your question about your specific asset. Okay. All right, guys. Thank you so much for joining me today. As always, I really appreciate you taking your time out of your very busy day, not only spending it with me, but investing in yourself. We will see you next week.